to a share screen, I believe. And okay, and I'm going to go back here. And we're going to move off the screen just for a sec.
He's wrestling his dog.
And I just shut the door, and now he's going to be angry. He's not even included in the presentation. Okay, so what I've been doing is, and Vanessa is going to play a very key role in this as well, because she has individuals that she feels can possibly benefit from this. But this is going to be something where you're attacking early interest. If you're familiar, when you have a mortgage, you have interest. If you look at your mortgage statement, you'll notice that majority or a large share of your money is going towards interest and not principal, because you have an amortized loan. On a simple interest loan, which is a home equity line of credit, you pay level interest. So what I wanted to do is I wanted to show you just a few things and how I present and have people think about this. And each of us, basically, I'd like to ask you as you listen and watch, and we'll go through this, to allow yourselves to think things just a little bit differently, because a lot of people feel, oh yeah, I make the payment, everything's great. But I want you to think of things just a little bit differently as I go through this today. If you change the way you look at things, you'll find that things will change. It's a matter of perspective. When you were in school, you were taught things a certain way, but you never stopped learning. Okay, life, it never stops teaching you things, and you have to have that open mind, and that's what I want to kind of show you today. And, you know, it's thinking differently about money. You were taught one way, but it's not necessarily the perfect way. And what we're going to do today is we're going to show what we know, what we don't know, and what we need to know, and then see what we can do to help benefit ourselves. A lot of people change the way they do what they do because of what money is there or not there. And sometimes your dreams, your goals change as a result. But sometimes your current income is actually adequate if it was actually working correctly for you. And that's the power of using, there's various principles of money that we're going to share. And I want to show you how that can maybe be available to you, and maybe you can reach those goals and dreams. Now, we were just kind of talking about it, but you know everything going on now with inflation. With inflation going up, you have various prices. Maybe some grocery items are getting a little bit better, but when one thing goes, the other one goes. We've seen our gas prices. So depending on how you're commuting and what you're doing, that's going up higher. Sometimes you're at this level, sometimes it goes down, sometimes it goes up. I mentioned about groceries, depending on the groceries you're buying. I mean, just going out to eat has gone up a lot. You look at housing. I just talked about insurance. I just talked about the possibilities of other items when it comes to different items on rent, people that are renting. They're talking about a new item here in California now. They're trying to limit landlords to only charge 1 month's security deposit because they want to make it more affordable. But again, they're doing that for the people coming in. But what does that do to the people who have that business and now are upside down on repairs and items? So there's one consequence that will lead to the other. So sometimes fixing one problem creates others. And those are some of the things that we'll see. I mentioned about student loans. This is going to be a big item come September 1st. And we're going to have a lot of people crying some pain and getting affordability. Talk about inflation, disaster, 40% of Americans. We're looking at 64% are paycheck to paycheck. And with that, we're looking at discretionary income. So as I go through all that, you ask yourself, what's your biggest expense you have? And a lot of you are thinking, oh, it's my mortgage, or it's this, or it's that. It's collectively interest. When you have a home loan, as I mentioned to you, it's skewed heavily towards interest up front. You may have a 3% loan, but I'll show you you're paying close to 53% over the lifetime of your loan. And we'll kind of show you how these numbers work. But what this opportunity is going to show, if there was a program to help eliminate and pay off your debt, personal and or business and mortgage, in a third or half the time without refinancing or changing your lifestyle. It would be interesting to learn more about that. Okay, that's kind of what this is about. Now, why aren't they doing it in an efficient manner? Because the banks have a plan. Let's go back to Let's Make a Deal. This is the more modern set. Most of us remember Carol Merrill and Monty Hall, but now it's the more modern set here. But the bank has a plan. So if I gave you a choice of 1, 2, or 3, right now, you don't have a plan. You can't choose number 2. You can't choose number 3. You only have choice number 1, the bank's plan. You make your payments 30 years. You take an early payment. All of a sudden, they tell you next month you don't have a payment because they're trying to get you back on their plan. If they're gaining interest at a 50% level up until about 18 to 22 years into your loan, okay? So you're sitting here paying that much interest in early years. If you only have the loan or the mortgage or the home for 5 to 7 years, they're earning 50, 60, 70% interest on that 3% loan. That's what I want to show you today. So door number 2 is eliminate debt. So our goal is to eliminate debt as soon as possible. Door number 3, we're building wealth. You eliminate debt, you build wealth. And most people are stuck in this idea of the bank's plan. The company that we're talking about, 2 individuals who had formatted a mortgage company. They did this in the early 1990s out of Utah. They had a successful company. But what they found was there was a debt epidemic, just as there is today. People were basically coming back every 2 to 3 years and refinancing and using their loan as a piggy bank. I've seen that also. I got started in 1987. The thing is, I try teaching people to keep their current payment and pay down principal with that extra payment. People, though, of course, when you have a statement comes in, you could pay this. Why not? They pay the lower amount. They start over. And that's where people say, oh, I refinanced. I started over. You didn't have to. It was a decision. Just if those of you remember, you have a pay option arm, the negatively amortized loan, where you have 4 options. People paid the lowest and got upside down on their loan. So that's how that happened, because people's instinct is to pay a minimum. They want to save money or they want to spend it on something else. I had a client most recently when, let's say, the presidency was about to start on our current president, and he didn't want to pay off any of his credit cards or his student loans or any items with his cash out because he said, my president's going to pay it for me. That was his idea of his solution to his debt. So after talking to him for a little while on his credit cards, I asked him, so what did I buy for you? And he goes, well, what do you mean by that? I go, well, if you're not paying it, I guess I am. So what did I purchase for you? And he says he thought the credit card companies were really evil to allow him to be able to do that. Okay. It was kind of an odd statement of such. But what they did was they wanted to develop a program, and they spent $19 million actually developing a program that has algorithms, different items. They have different versions. They've tested it. They've gone through it. They enhanced it. They have had various versions of the program to help out as the market has moved and changed. In 2008, it won an award from Ernst & Young. Very difficult to do, but they go through the financials, longevity, retention, all the different things that they do. And you have some of the companies that have won it in the past. So large names that you have heard of. So right now, as of May 26, a little bit outdated, but the company has eliminated $2,444,302,672. That's how much interest has been eliminated at this time from the opportunity that I'm showing you and what I'm showing clients how to do. And I'm going back to my past clients, current clients, and radio clients, and we're showing tremendous savings. Now, for our sake today, I can go through it. It's only 2 minutes, but this is a video I just want you to watch briefly.
Do you know how much of your mortgage payment goes to interest? Whether you're an experienced homeowner or a first-time buyer, you probably know that a good interest rate is critical to paying off your mortgage successfully. A difference of just 1% can mean thousands more or less in your pocket after your mortgage is paid. Even if you think you're getting a great deal on your mortgage payment and an ultra-low interest rate, you're probably not getting the full story. Because the banks want their cash up front, your mortgage payment is front-end loaded. So you'll be paying a lot more in interest from the start. That means less money towards your actual loan payment and more money in the lender's pocket. So take a guess at what percentage of your monthly payment goes to interest. 10%, 20, maybe even 30%? Not even close. On a $300,000 30-year mortgage at 4% interest on your very first payment, you'd pay $1,000 of a $1,432 monthly payment to interest. That's 70% of your payment going straight to the bank. So what can you do about it? It can seem impossible to fight back against your lender, but if you think you have to settle for a future of high interest rate mortgage payments, think again. Imagine a future where you're debt-free, a life of comfort, confidence, and financial freedom. We're talking about a tool that could save thousands of dollars for you and your family and empower you to live the lifestyle you've always dreamed of. The best part about it, it's not a dream. It's not magic either. It's called the Money Max account, and it's already helped Americans eliminate over $2 billion in mortgage and other debt payments. United Financial Freedom developed the Money Max to be an all-in-one tool designed to get you out of debt as quickly as possible. By strategically calculating your payments, debts, and other expenses, Money Max can help you get out of debt in as little as 7 to 10 years. Why pay more to the bank for more time than you need to? Skip the expensive interest payments and get ready for a debt-free future with the Money Max account.
So that kind of gives you kind of a summary of what I was already talking about. And the biggest difference is it's utilizing technology. A lot of technology people here. It's utilizing technology in money and finance. How many of you still have roadmaps sitting in your glove compartment? And you're driving around, you pull them out, and they're blocking the dash, and oh my gosh, nice traffic accident. You know, you're not doing that. It's the same way when you were little and then you bought a calculator and you've moved on to that. Technology and things change, and it's also utilizing it the way we can in finances for a perfect financial GPS program. And that's what this is doing. It's using GPS technology just as you would have in your car or on your computer or on devices. And it's looking at how you can take advantage of that and do this. As we said, if you had a $600,000 loan, and this is coming right from your closing or your papers of disclosure when you're doing a home loan now, it shows you on those disclosures a total interest percentage. And ironically, they call it a tip. So you're leaving a tip for the bank. This individual was going to be paying 127% interest. When you look at the total payments, you look at the amount of the finance charge, he was paying more in finance charges than he was in the loan that he had. And that's current money. That's current rates, mid-6. So of course, as the rate's a little lower, it may not be 127. Maybe it could be a little bit lower. But let's look at the $600,000 loan at 6.5% over 30 years. Okay, when we look at what's going on, and I got something that's the chat thing is right in the way, so I'm going to move that. We look at over 6 months, he's making payments of $22,752. He has interest that's going at an amount, and all of a sudden my thing is not there. We go. So interest is $19,000. How much principal? He only paid $3,297 in principal. Okay, that's it. So it really makes a big difference. If you look at that over the first month, and then you look at 85% interest that he paid, you look at year 5, you're still talking huge differences of what you're paying towards interest. So you may think you're doing really well, but really you're not really quite. It took 21.4 years just to get about 50-50 on this loan. And that's still 50% interest. So over the 30 years, 56% interest. Okay, that's what your current bank plan is doing for you right now. So this is thinking things a little bit differently. And I know, hey, I'm just making my payment, I'm doing what I'm doing, and it's great. But they're loving you for that because that's how the banks make their money. If you took it all the way down to 3%, which some of you still have, it's still the same math. It's 60% interest on the first part, and you're still paying a lot more interest. And then if you go to the halfway mark, 19 years, you're still paying 52% interest. Amortized interest isn't as clean as it should be. So using formulas, using math, and utilizing different items for a cash flow process, only using a checking and savings, maybe credit cards. If you have lines of credit or life policies, insurance, that could additionally help. And we can go over things at a later time, one-on-one if necessary, if you like. But we've been able to show that even if you have a $100 a month of discretionary cash, we could start canceling interest debt and get you much, much further. So it's a question. If you looked at all these items on a typical individual who has credit cards, student loans, they have mortgage payment, auto, all this stuff, you would look at this and go, well, gosh, which one's the most expensive loan? Okay, are you looking at interest rate? So my God, I want to get rid of this 18% interest rate. Oh, I need to get rid of this 21 or 18, 12% rate because my 4% is really good. This amortized loan is actually your most expensive loan. It's based upon the amount of years that you have them, but also it's simple interest versus amortized interest. The longer you have the item, the more expensive it's going to be. In this case, your mortgage and your student loan end up being the most expensive over the years. So these are the things that we try to look at. You look at the overall, the first and second. So the program is going to analyze and attack the most expensive items rather than have you try to snowball or do an avalanche or try to do it or throw darts, but maybe not be able to do the right game. Maybe you're playing that game, but it's not the right item. Where you are in your life, you're at a different point of what you want to do. If you want to create wealth, eliminate debt, buy more units, create more doors, there's many different strategies, but also your health is there for our healthcare professional. It's a question what you can do and where you're qualifying and what it is you're wanting to do at that time. So this is a typical family. They, let's say, make $5,000 a month. They have total debt, $226,250, monthly debt payments of $1,715, monthly expenses, $2,350. Their current debt-free times could be like 30 years. Okay, total interest to pay is $234,000. Under the Money Max program, they'll be debt-free in 9.2 years. What we will do is we will put together a side-by-side spreadsheet once we enter in your information or a client or referrals information where, pardon the expression, crap in, crap out. If you have the right information, we can get the right information out. You put bad information in, you get bad information out. So we're going to want to know all income, all assets, all items, all debts, all monthlies, and it's going to come out to a potential program. So this is now what we're doing to educate people to add and pay things off. We've had clients from 26 years, total interest, and now they're sitting here paying off these items in this amount of time. And they're not getting a second job. They're not sacrificing various items. They're not living on pork and beans. They're not living in a tent in the backyard. They're actually doing what they did now, but the money's being more effectively working towards them. And I'm kind of moving forward. I don't want to keep you guys too long today. But the Money Max program is going to allow you to then have that impact. The opportunity comes with support coaches. I'm a certified field trainer as well. You would have that ability. There's income opportunities there as well, but we can kind of go over that another time if that is of interest to you. Maybe you're between items and you have a great Rolodex. Say Rolodex, we're dating ourselves, aren't we? Of information and timing of what we have. So you have people that maybe could benefit because they have debt, and we could look to get them a better debt-free date. Those people in sales, insurance individuals, they're looking to free up monthlies to allow premiums to protect their families, being able to afford those student loan payments. If we can show them how to pay off things a third or half the time, what happens if you pay it off that early and now you have all this monthly money that you normally would have been paying, and now you can use it for investment, wealth creation, property evaluation? We are looking at when you, as far as this saying here, when you can't change the direction of your wind, adjust your sails. These are the things that we want to do. You got to be able to pivot in this market. And these are the things that I find very, very important. Now, I'm going back to the same statements I said earlier. And again, I'm rushing through because I don't want to keep you guys too long. You got a lot of stuff to do. But this is one of the things that we do, and I try to personalize it to each individual. So the goal is to do this in a way that we take each individual's purpose. Here we're doing a group setting. Every one of you are at a different point in your life or a different goal that you may have for yourself and your family. Some of you are trying to eliminate debt and you just want to be simple, and that's what you want to do. Just get rid of it. Let me live my lifestyle. Some of you are still at the point, Rajit, you mentioned about getting started. You want to create wealth, do more. We have individuals that are doing real estate. We have one individual who owns 114 properties, and he's actually now has 86 of them free and clear as a result of this. He's paying off properties in a year, 2 and 3 years. And he's then buying more because he's getting rid of all that interest and obligation. I had a 75-year-old woman who decided to purchase the opportunity. She was going to be debt-free when she was 103. I asked her, are you going to work just as hard as you are now, self-employed marriage family counselor at 102? And she laughed, head on the table, laughing. We did the program and she's going to be debt-free in 5.9 years. She's just doesn't, again, it's going in the lane of understanding money and how the banks and the insurance companies work from the other side. And it's having you become the bank. So this could be right or it could be not right for one of you, depending on where you are. But as you're creating wealth, it also works with variable income. So we can actually put it in as such, and the program is smart. Something I'm going to show very quickly. I kind of want to do this here as I kind of see, I'm trying to share my screen here, but for some reason, it's not giving me that item. So we're going to go to the wrong screen so I can go to the right screen. Okay, so all intents and purposes, it's giving me that. This is a screen where it's showing you my debt. This is me. I'm being very transparent with you. This is my screen as of right now, finishing off interest for the month that I put in, transfers and items. It
We
gives
don't
a
have the right
90.
screen. We don't, we have a Zoom screen.
Oh, geez. Okay, but mine says it's sharing it, so I'm sorry. I'm not sure what to do then. We're back to that. Okay, so I'm not sharing it, so we'll go back out of that, and we're saying we're not sharing, and I'll talk about it. And I'm hitting stop share, and now the stop share button doesn't work. There we go. So it goes 90 days out on a schedule. My debt-free date went from 26 years down to 7.7 years. This is real money, people. So when you think something is not there and this is all smoke and mirrors, it's not. So what I challenge you to do is get back at Vanessa. We will run a schedule and talk to you individually to find out where you are in your goals. Your information is private and fiduciary and all that. But bottom line is, my goal then is to show you your debt-free date so you can make some decisions. Because right now, your lender loves you and you don't need that kind of love in your life. You need to make it stop. And I say that on my radio show. So I'm glad, Sigmund, you have that reaction. That's the reaction I look for on the show that I can't see. And then if you're renting, your landlord loves you. You are making a mortgage payment. It's just not your own. So these are the things that I try to instill in people to understand so they can move forward. And it's not, yeah, I'm going to pay this one off. Well, I'm going to pay. Well, you're playing the game, but you're not hitting the board in the right spot. And this is a perfect.
Michael, can I ask you a quick question?
Please, absolutely.
And before I go, because I'm at a car dealership, my first car service, my only debt is my mortgage.
But that's
right
a big
now.
debt, and that's the worst debt based upon this program.
Yeah. And so do you have a program that offers how to work on that alone?
That's what this program will do. What it will do is, for instance, I charge things monthly and I pay them off. Okay. And my dog has had it, so he's coming in. I want to keep the health of my door. Okay. So it will attack that mortgage appropriately with the right opportunity. But what I would tell you, if you have the equity in your property, I would have you look at a line of credit, not to get in debt, But if you use that line of credit on a monthly basis, not to go, oh my God, I'm going to pay 50 grand off. No. But if you use a monthly, and I'll use this example, and I'm not the perfect financial GPS, but it will tell you how to do this right away, and you just follow the direction. It's always nice to have someone smarter than you in the room who doesn't talk back. And that's what this program does for you. But if you took your equity line and you took out money this week, next week, the next week, and the next week, your average balance is only 50% of what you took out. So your interest that you would owe on that line of credit is half because it's based on the average balance. If you took that money and paid your mortgage, I showed you those 6 payments, you're going to take $5,000 and pay off $22,000 of interest. If you rinse and repeat, and pay that down, you're going to gain another 1.5 to 2 years off of your balances. Just by using a line of credit as a tool, not as a full,
Now,
oh my God, but it's a tool monthly.
my next question to you as a financial lender, and then I got to go. My next
Yes.
question is, where do you see the market and home values going right now? Because we all saw our home values skyrocket.
Mhm.
Are they going to hold? Or are they going to come back down?
Well, the
Or what they'll call a
skyrocket,
normalization period that's going to happen?
well, the skyrocketing kind of disappeared, and you kind of gave a lot of that back. But if you look at it over that time, in certain markets, you're still breaking even, if not even still going up. But right now, we still have inventory scarcity. And we're not seeing that changing right now. But I talked about earlier about if they change the capital gains, that might influence some baby boomers to sell, because of the capital gains and the tax issue. But I'm not seeing a drastic move down. No, I'm really not.
Fortunately, based on where I live, I was fortunate enough to see my home value double.
Yeah. Oh, absolutely.
Yeah.
The home that I sold a little over 3 years ago, and again, it was in Thousand Oaks, California. I sold that property for just shy of $1.6 million, large home, downsized. And now it's probably worth about 2.1. And then I lost 500, but I didn't lose 500 because at the time, if I made that extra 500, how much in taxes I would have owed because I would have been over my 500 capital gain that I was just on the cusp of hitting. So that would have been a problem. So then I bought my new home, and my new home went from 800,000 to $1.2 million. So I gained over here, but I didn't lose the taxable capital gain. Now that new capital gain rule may have influenced me differently at that time, but I had to play the rules of which we were given now. But again, where are you going to go? You sell high, but where are you going?
Exactly. Yeah.
And then what happened to your tax rate? If you can't carry it over, depending upon your age and your prop, whatever, and what you can do.
Well, I know there's a California state law that allows you to transfer your present tax on your property to your new one. But that's only if you're buying up.
Yeah, 55 and over, buying higher, right. So there's caveats to it. So that's the thing. People all of a sudden have these low, and then all of a sudden, where am I going? Unless you're going out of state and cashing in your chips, then you'll never come back.
Right.
Because it's hard to afford the back trip coming in. But again, Brian, I know you got to go, but if you wanted to actually get that analysis based on that item, Vanessa can get back with you too, as well as I can. I can send you a spreadsheet. We can plug that in, and we can have a quick private session so I can show you what your numbers could be.
Okay. Well, I sent you a link, an invite on LinkedIn, so I hope to contact with you.
Okay. Excellent.
And as always, everybody, nice to see everybody. Sorry I have to leave early. My car's ready.
I appreciate you staying. See, I never know when a radio listener leaves, so thank you.
That's got to be the weirdest reason for leaving. My car's ready, but anyway, onward.
Yeah, there you go. Yeah, he's been sitting in the waiting room on the call, but that's really as simple as it is. It's running your numbers to find out, and you might be skeptical going, oh, gee, it's not going to do, but I'm really good at this. I have spreadsheets. I can do all this. It's substituting all the time you're spending, that this is going to be about 15 minutes a month because the work's going to be done 24/7 for you. When I log into my page and it gives me exactly what I do on a daily basis and what I can do, I still keep my Excel spreadsheet just because that's who I am. And it doesn't take me much time, but it allows me actually to do things, and you could do future forecasting. For instance, I have a life insurance policy, which I can borrow from at 7%, while it pays me 5% to pay off debt that's over the 2%. Okay, my mortgage is at 2.75. I'm making money by borrowing off my insurance policy. So I have money that I'm distributing from my policy, and that's coming in the middle of June. I thought about this and did this 4 months ago. I put it in as a predictive item. It actually lowered my payoff dates by 3 years when I did that. But I was able to put the future forecast in. Then it came in and tells me all the transfers and all the things I'm doing as a result of doing that. If you're looking to buy a car, you could put it in there. Oh, gee, I'm going to finance it over 72 months. It may have only increased your debt a year and 9 months because the program is smart to eliminate that better than just being on the bank's plan. So a lot of people, as he had already left Brian, oh, I just have a mortgage. Well, you're never going to buy anything the rest of your life. No new car, no new this. So it gives you that predictive analysis. Now, the new thing that's coming in that I've been able to see it used for is Social Security. Should I take the money now, a little later? Should I wait till I'm 70? Should I take it at 62, 65? You can put those numbers in and it will tell you your debt elimination and why it's better to either wait or take it today. So you go to experts for that, but the program is going to give you the mathematical answer of when you should take that retirement, take it today, wait, and whatnot, and you can put it all in there, and it's going to compute it within seconds.